Well, sticking with the consumer, shares of Starbucks closing in the red, but off the worst levels of the day. The company announcing a $1 billion restructuring plan. Investors cooling on Starbucks this year, more generally. It's one of the worst staples performers in 2025. But joining us now for more is Andrew Charles, TD Cowen senior equity analyst. He has a neutral rating on Starbucks. Joins us here on set. Welcome.
Thank you.
What do you think of the announcement today?
You know, I think it didn't really change anybody's mind. If you were bullish going into this, they had hinted at this before, and this just puts more numbers around the number of store closures as well as some of the restructuring charges as well. If you're bearish, you're looking at saying, hey, this is a little bit more of a larger magnitude than we expected, ourselves included. We're seeing that 900 jobs unfortunately lost, around 500 store closures in the United States. This turnaround obviously these are necessary actions to take, but the turnaround obviously is ongoing.
So when you hear about this back to Starbucks strategy, this is just one more piece of that in the Brian Niccol, vision here. How similar is it to Chipotle?
It's different. I mean, the issues facing both companies were quite different. So, Chipotle had one massive issue around food safety. Starbucks has, call it 5 or so medium-sized issues just around the culture and making the operations better. And so, the first year of Brian's job in the role, very important that he focused on getting the house in order, making sure operations were better. Now they're starting to go more on offense, and this is where it's really crunch time for the company as investors are looking to see signs of improved sales performance. We just had the Green Apron roll out with all of the increased labor and increased staffing behind the counter. We're going to get protein coffee in the month. So investors are looking at right now as the crunch time to see are sales going to pick up.
The part of this announcement I'm most curious about is the idea that they're going to close stores that aren't designed in a way that fits their ongoing strategy. And I wonder if you have a sense of what that means. Is this a return of that sort of third place idea where they need more or different types of room for hospitality? What are they closing, and what should investors take away from that?
It's not a one-size answer. So there's a Starbucks Go concept that was only for pickup. They announced that they're going to close those stores as part of it. Clearly, there were some stores that were just seen as cash flow losers or just financial underperformers. They got rid of those as well. But to your question, there's going to be ones that, hey, the space didn't fit, the vibe wasn't right. These stores were also closed. But the whole goal here is obviously to close the underperformers to improve the financial performance and make 2026, off to a better start between same-store sales and margins from closing these stores.
Is food a part of this at all, or should we think differently in terms of things like the protein shakes, which are potentially a higher margin contributor? Are they looking to sell more, looking to get a bigger share of wallet?
Food's going to be a piece of it. Beverage is critical, given the margin, as well as given the habitual nature of it. And so getting beverage right, making sure they have the most relevant offers, going more on offense, with innovation. Historically, Starbucks didn't do great in the last year or so with some of the menu launches they've had on the beverage side. And so making sure they're doing things that are going to be better for the consumer and really drive traffic more. And food's going to be a piece of it as well. They obviously want to build attachment, given about 40% of people attach food. It's about 20% of their sales, but lower margin, it's key to get that beverage, especially to get the habit.